Even great to have you today on ET Now. Just going through your performance, and your NIMs were already at a lower end of the guided steady state range despite your loan yields improving on a sequential basis. Should investors now assume, Mr. Vasudevan, that 7% perhaps is going to be the normalized level of your NIMs, or do you expect some expansion in the second half as deposit repricing stabilizes for you?
Yeah, good morning. So we had a NIM of 7.36% on a daily basis calculation method in the last quarter. That's fourth quarter of last year. And on the same basis, for the first quarter, the NIM turns out to be around 7.24%. That's a 12 basis points drop in the first quarter. Cost of funds had gone up by almost 11 basis points, so more or less accounting for the drop in the NIM. We expect our cost of funds to slightly go further up in the subsequent quarters. It is 7.05 in the first quarter. We expect that to reach somewhere around 7.1 to 7.15. But that 10% or 5% increase in the cost of funds might be offset by higher yield, because if you see that our yield has actually gone up in the first quarter towards the end of the quarter, that benefit will accrue into the second and third quarter. So we more or less expect that to match the increase in the cost of funds that we are expecting. So NIM from 7.24 on the daily basis method that we have set out in this quarter could come to maybe around 7.15 or 7.14 in that range for the rest of the year.
And hi, Mr. Vasudevan, this is Harsha. It's been a while. Trying to get a sense, therefore, how is the credit environment behaving for you in terms of your book, and how are things shaping up? Just give us a sense of that.
Yeah, so at Equitas, our advances portfolio is very wide spread out. Small business loans contributes about 40% of our book. Vehicle finance, which is largely used commercial and used cars, contribute about 25%. Affordable housing around 13%, microfinance around 11%, and the remaining is MSME and NPOC lending. So we have a very broad range of products under which we lend, and that brings a lot of stability to the book. And with microfinance having turned the corner in the last quarter itself, last quarter of last year itself, we see that the net slippage is the lowest in the first quarter compared to the first quarter of the last 5 years. And that shows that the portfolio has actually been performing very well and very strongly in this current year, in spite of whatever we are seeing in the middle, Asian countries, the geopolitical issue in the Asian countries, and the El Nino effect. I think our portfolio is still showing a lot of resilience, and we expect that we have been guiding a credit cost of around 1.5%. But seasonally, the first quarter is supposed to be the weakest, and we delivered a credit cost of around 1.35% in the first quarter. So that gives us hope that we should actually be doing better than the credit cost guidance that we have given earlier.
Better. Very interesting, Mr. Vasudevan. The cycle is improving for you. It's very evident from the tone, from the confidence. Give us a sense, therefore, 1.35 Q1, does it sequentially keep getting better for you? First, give us that perspective. Where do you exit?
So last quarter, we exited at 1.1% credit cost. And, normally the fourth quarter is always the strongest for most of the players in the industry. So we do expect sequentially that the credit cost should improve from this 1.35 level and hopefully reach that similar 1.1 or 1.15 by the fourth quarter. So that's what we expect for the rest of the year on credit cost.
Okay, and therefore, this 1.5% guidance, it'll directly impact your ROA guidance as well. Your ROA will likely therefore trend towards 1.5% full year, and exit will be even stronger. Is that the right way to kind of think of this?
On ROA, we had earlier guided for a 1.2% ROA for the full year with an exit ROA of 1.5% for the fourth quarter. But our first quarter ROA itself has come to 1.2, which we were actually expecting it to be around 1%, but we have ended up delivering 1.2 in the first quarter. And with the credit cost coming lesser than what it was in the first quarter in the subsequent quarters, you're right. We should expect our NIM to be better than that 1.2 for the full year that we had guided earlier. And let's see, we will probably be able to give a better idea by end of the second quarter. But definitely, we are in a position to deliver a much better ROA than what we had guided earlier.
Give us also some color, Mr. Vasudevan, on how the various segments are panning out. MFI, for instance, it's seen a growth of about 70%. Is this current run rate largely market share gains or industry recovery? And how is it that competitors are now, sort of shaping up in this segment?
So microfinance, the stress that we saw in the last 2 years has actually really played itself out. If you look at the industry, overall industry level, the total AUM at the industry was around 4.5 lakh crores by March 24, and that's come down to around 3.5 lakh crores by March 26. In a 2-year time frame, the industry has actually shrunk by 1 lakh crore on a base of 4.5 lakh crores. So that is de-stressing or deleveraging at the industry which has happened, and that is why we see that the performance of MFIs across the board has improved for all the players. And we expect this trend to continue at least for a couple of years. So hopefully, minus any possible external event, we expect this trend to continue. And our growth in microfinance was higher in the first quarter, largely because last year we were degrowing microfinance. That's why the percentage of growth looks very high. But as guided earlier, our microfinance should be typically around the 10% of the advances level, and that's where we are today, and that's where we will expect to be in going forward also. And the rest of the non-microfinance book has continued to perform very well. Our growth in the non-microfinance book is 25%, which is 90% of the book. That has grown by 25%. And our credit cost in the non-microfinance book, the rest of the book, continues to be very strong. It's around 1 to 1.1%. And so we expect that overall, across all products put together, this year we are expecting it to be a really good year for the bank.
Talk to us about the next couple of years, just in terms of growth, right? The last couple of years have been difficult. The next couple of years, will all your engines fire, and therefore very likely for you to be, fully in growth mode, if I can call it that? And will it last? Is it a multi-year kind of an expectation?
The non-microfinance book, even in the last year, when it was a stressful year for the bank, the non-microfinance portfolio did grow by about 19%. And the microfinance is where we degrew, and we had a lot of credit cost issues also in the microfinance space. Going forward, we are in small business loan, which is 40% of the book. And in small business loan, the unmet credit demand in the market is around 22 lakh crores based on various government data. And in the affordable segment, where we are at 13% of our book, the unmet credit demand remains around 45 lakh crores, based on, again, various reports from the government and others. So if you look at it, we are in a very sweet spot in the sense that most of our lending is into segments which has a high level of unmet credit demand. And the traditional banks have a very little role to play in this space because of the difficulty of doing business in the space. We don't see the traditional players really present in the space. And that gives us a huge advantage that, yes, we should see a multi-year strong growth going forward. And the microfinance issues, what we saw last 2 years, I think we have kind of systemically addressed that by bringing it down from 21% to 2 years back to just 10% now. And we'll retain it at 10% so that it gives us a kicker when the markets are good. And if the microfinance goes under stress, the 10% should not hurt the bank too much, while the 90% of the book should continue to do very well. So I think, yes, we have created a platform from where we should really be able to look forward to a very strong growth over the next few years.
Therefore, do you double in the next 3 years at the very minimum? Is that something that you would expect Equitas to do? You're at roughly 50,000 crore in terms of loan book size. Does it double? Second, how crucial is deposit growth for you? If you can give us some color on what the rate of growth would be on both loans and deposits.
So, we had done an Investor Day presentation in the month of June, and we had set out a 5-year goal of achieving a 20% CAGR over the next 5 years. So, which means that in a 5-year time frame, we said that we will go maybe about 140% of where we are today. 130 to 140%. In terms of doubling in the next 3 years, I'm not going to be able to answer that immediately. But definitely, yes, that will be our goal. That our growth rate should be more than 20% is for certain. Whether it will be 25 or around the 25% level is where our effort will continue to be, and we should see a strong growth in the next 3 years on advances. As far as deposits are concerned, yes, our deposit for the first quarter actually has been one of the lowest in the industry. It's a 10% growth is what we saw, which is not very comforting. And our credit to deposit ratio, if we include the refinance we borrow from institutions, was at about 82%, which is comfortable. But if we remove refinance and look at it on a standalone, then it is 92%, which is not that great. So deposit definitely is a focus area for us. And thankfully, we have done a few changes in our interest pricing on the deposits in the month of June and July. And thankfully, in the month of July, we have seen a good traction on deposits. And for the first time, I think our retail deposit should post the highest monthly growth in the month of July. And the FCNRB window, which was opened by RBI also, we started FCNRB with a $35 million book before the RBI window opened. And we thought that we will double it during the next 3 months to 70 million by adding another 35 million. But in the first month of July, we have added 17 million out of that 35 million target. So we have another 2 more months to go. So I think FCNRB also is going to be a good kicker in our deposit mobilization efforts. So I think there's a lot of progress we are making on deposits. And I don't think we should see deposit growth in any way impacting asset growth.
Right. Okay, Mr. Vasudevan, good luck with that. And thank you so much for speaking with us today.